Okay, welcome everybody to today's webinar reviewing your SMSF contribution strategies. I put a fair bit of content in this one for your takeaways, and of course you'll get a copy of the slides sent through from SuperGuardian afterwards. But I think I wanted to focus on a lot of the strategies that I often talk about in these contribution updates, but also just throw a couple extra ones in there in light of Division 296 and what the future holds. So let's jump in. I'm not going to spend a lot of time talking through some of the rules around contributions and other things, because a lot of those issues are areas that I speak about on a fairly frequent basis. And so, the things around things like the acceptance of contributions and those sorts of rules, there's an expectation that you come here today knowing that you understand all the rules, that we can contribute up to 75, and then we can only ultimately get our mandated contributions beyond that, and our downsizers. So, having an appreciation for where all of the rules sit, I wanted to focus more so on the strategies in light of not only indexation, but also Div 296 with regards to where we sit. So what we know, and of course those of you that attended last month's webinar will have been through these numbers with me, but we've got the main three changes for the 26-27 year is the change in the increase in the general transfer balance cap, which of course then we link to our non-concessional contributions. And of course, our non-concessional contributions went up because our concessional cap went up. So we got 32,500 from a concessional point of view, 130 from non-concessional. And then we had other changes, the CGT cap, super co-contributions, and of course the maximum contribution base, which I touched on before, which is moving to an annualized number in light of payday super versus currently a quarterly number. So that's kind of where there's a concept. Look, I apologise that there is some echoing. If there is some echoing, I had an issue with the microphone, so I'm relying on a different microphone today. So unfortunately, that's all I can do. I can try and change the mic to a different one, but I'm not sure that it's going to help. Just try that. So I'm now using a different microphone, so I'm not sure if it makes any difference to the quality or not. But just maybe put a comment in the chat box or the Q&A if that has changed the quality of the audio. So indexation has changed a couple of key things with regards to the numbers that we're using moving forward into the new year. And of course, what that then does is it carries forward through to our bring forward, and ultimately it produces this opportunity where, subject to our balances increasing, we've got the higher general transfer balance cap, which means more opportunity for those with higher balances to utilise the bring forward. And of course, with the increase in the non-concessional, we go from 130 to 260 to 390. And it's one of those interesting sort of times, I guess, when we look at this sort of stuff to recognise that when we're looking at, say, this year from a conversation piece with our clients to say, well, if you're triggering the 390, sorry, if you're triggering the 120, 240 or 360. So if you're putting in more than 120 this year, then you are moving into that new environment. But and for some people where their balances are borderline of those, the 1.84 million, of course, anyone close to the 2.1 next year, looking backwards, there's different opportunities that you can work on with regards to non-concessional, and it might just be that you say, okay, well, if someone can put 120 in this year because they had close to that 1.88 last year, and now their balance has grown a little bit, and they maybe next year don't get the full 3 year, but they've only triggered single this year, so they haven't put themselves in a bring forward position, and so next year they can still put in potentially 260 if they've got under or between that 1.84 and 1.97. And the beauty of that is that if you got 120 this year and 260 next year, it's still more than the 360 combined. So, not triggering the cap now certainly can work in favour for a lot of people. And of course, the other thing and the final thing I'll talk really about with regards to the use of the bring forward is what's important is to make sure that we go back and look far enough and look at the previous years so that we're looking at. I think always should be going back 5 years to look to see that you're not at the end or at the start of a bring forward position or a period for a client. So you're always looking there to go, okay, well, was the contribution, let's say somebody contributed 180 this year, you go, well, 180 would trigger the bring forward, but it could be the end of a previous cycle. So, have we actually gone back far enough to work out what we're looking at with regards to our actual cycle? So they're the things that I tend to focus on when talking through the various sort of non-concessional concepts with people around contributions. But I'm going to come back to non-concessional towards the end of the session as I look through the various contribution strategies, particularly in light of Div 296, which of course, as we know, is in place from the 1st of July. So, we have to have that in the back of our minds when discussing with clients moving forward. So let's move into our contribution strategies. And of course, this is a slide that many of us are familiar with. If you've attended my presentations before to do with contributions, I like to list, all of the opportunities that exist for our clients. And I think it's also, a good opportunity now to review these in lieu of things such as Division 296. And I think that's going to become a common theme with regards to clients moving forward, is that most of our clients that sit in, say, the realm of being able to make non-concessional contributions, so they've got less than the general transfer balance cap in their super fund, they're probably thinking, well, we're not impacted by Division 296. Of course, what we have to factor in there is how many members in the fund, with regards to all of the members that are in the fund. Are they spouses? Because if they're spouses, what are their pension strategies? What's their estate planning strategies to contemplate? Because how is that going to impact their balance, their $3 million balance, if and when one member passes away and the balance transfers across to somebody else? So having an appreciation or an understanding of even those not currently impacted by Division 296 might be impacted by Division 296 in the future, and that's going to be something strategically that we're needing to be mindful of and being aware of when dealing with our clients. But of these, if we assume that a lot of people say they carry forward unused, people that are making personal deductible, most of those people aren't going to be under the realms of Division 296. But where we've got people that are looking to use the small business CGT, or people looking to use downsizer contributions, because they're not measured against the total superannuation balance, then they are actually going to potentially put people within scope of Division 296 in a singular sense, so as a single member versus as a recipient of a death benefit income stream or a reversionary pension. So mindful of that, and understanding that, of course, these strategies aren't going to apply to everybody. And when we look at these strategies, what we then need to work through is some of the simple things, which is, do any conditions relate to any of these strategies? And for me, this is a bit of a not a trick question as such. It's not. I'm not there to trip people up with regards to this, but when we're contemplating, are there conditions linked to the use of any of these strategies? The simple answer is that all of them have some form of condition attached to them. So, whether we're looking at recontribution strategies, if we're looking at bring forward, again, we're having to look at total superannuation balance for the member. We're having to look at age. With regards to salary sacrifice, do we have an arrangement in place, with our employer to be able to have that salary sacrifice arrangement? Personal deductible contributions. Are we under 67? So is there no issue there with regards to claiming it based on income because we're under 67, or are we between 67 and 75, and therefore we have to satisfy the work test to be able to make personal deductible? Obviously, other things like carry forward have conditions. So whatever strategy we're using, right, and particularly when we start to use the less standard strategies that I've got listed there on the right-hand side, we need to make sure that we understand all of the conditions that sit alongside of those strategies, whether it be elections that need to be made, timing, all sorts of other things that apply to it, and eligibility. Things like foreign transfers. Are we eligible to be able to treat some of that amount as applicable fund earnings, right, versus treating it all as a non-concessional contribution? And then if we're treating it as applicable fund earnings, will those earnings potentially be subject to Division 296 in the future as well? So just lots of things that I guess I like to throw out there from a concept point of view. And when we look at these strategies and understanding that there's conditions attached to them, it's then knowing what those conditions are, right? So knowing what we have to do from a not only a notice point of view or an election point of view, whether we have to provide that to the tax office, whether or not we just keep it on the fund, keep it as part of the fund records, when does that need to be provided? And you look at some of the things like personal deductible contributions and the strict nature of the timing there. If you look at things like downsizer contributions, small business CGT, if you get that wrong, if you get your downsizer contributions wrong, if you get your small business CGT election wrong from a timing point of view, that's probably far more catastrophic in the sense of contribution purposes than exceeding the non-concessional cap by, accidentally triggering the bring forward early or whatever it might be, because these contributions are much larger in their scope and scale, and so they're going to result in more significant excess non-concessional contributions. And I'll touch on that sort of stuff at the end of the session as well. So ultimately, having an appreciation for what your requirements are is really important with regards to all of the various strategies that you're going to implement with your clients, and from a timing point of view, ensuring that they meet their obligations and keep whatever records are necessary. And record keeping is going to become critical again. And look, I'm obviously going to mention Division 296 a number of times throughout the session today, but not only in a contribution sense, but record keeping for other administrative purposes, it's already critical, but it's going to be far more critical in a Division 296 point of view around things like our CGT election. But let me not get off track because, as I said, there's a lot of stuff for us to go through today. Biggest influence on our contribution strategies is our total superannuation balance. Okay, so we know and we understand that that we have our total super balance, which is our reference point for capacity to make non-concessional contributions. Or I really, I guess, want to reframe that, not to say that it's our reference points for our capacity to make non-concessional, but more so it's our reference point for what our non-concessional contribution cap is, which means it's our threshold for it's what we use to determine whether or not we're going to create an excess non-concessional contribution situation for ourselves. Because, as I've touched on previously when discussing this, and as I'll touch on again later, we don't have fund cap contribution rules like we used to, where trustees previously used to not be able to accept certain contributions, right? And then if the trustee accidentally accepted those contributions, they could return them within 30 days. That rule effectively is non-existent pre-age 75. Okay, so prior to age 75, basically, if we make a contribution, that contribution is going to be treated as a non-concessional, then it's going to be measured against the cap. So then our total super balance and other things are going to be relevant. But of course, we've got more than just non-concessionals measured against that. You've got other super offsets, government co-contributions. Again, I often sort of smirk when I'm talking about government co-contributions because rarely will somebody have more than $2 million in super and be eligible for government co-contributions. That's just my generalized assessment of that situation there. But typically where total super balance becomes relevant for the majority of our clients is around non-concessional contributions, but also eligibility for utilizing the carry forward of the unused concessional contributions. So there are our two primary points of reference when we're talking about these strategies with our clients from an SMSF point of view. Now, I created this contribution matrix for those that attended when I probably first went through this 12 months ago. What this was really about was identifying that there are different scenarios where different contribution strategies are going to be relevant, versus non-relevant. And probably it's easier to primarily highlight that blended family column on the right-hand side there because, what we want to be mindful of is that when we're talking to our clients about various strategies and the objective of those strategies, then, are we talking to them about balance equalization, right? Are we talking to them about tax-free versus taxable? So the tax position on it, which in effect is ultimately an estate planning piece. And if we're talking about the estate planning piece, then who are the additional beneficiaries to the member of the fund? So when we start to look at blended family contribution strategies, spouse contributions, contribution splitting, these sorts of strategies have to be sort of discussed at the level of, okay, appreciate that if you make a contribution for your spouse, particularly if you do a recontribution or a contribution splitting amount, right? So if you pull money out of your own interest and put it into the spouse's interest, then there is a natural flow-on effect from an estate planning point of view to say, well, your children are not their children, right? And appreciating that whilst everybody's alive, that is the stated position and the position that the tax office follow. But when somebody has passed away, then their natural children are no longer the children of the other party. So there's some key issues to be mindful of. So when we look through our matrix, we go, well, what's the point of certain contributions, right? What is the benefit to making something? And often it's going to come down to the estate planning outcomes ultimately for individuals and that whole tax-free and taxable, particularly whilst we're existing in an environment where anyone over 60 receives income as non-assessable, non-exempt income. However, you know, without sort of casting any shadow of doom or whatever over the webinar, the concept of legislative change is not new to superannuation. So can we expect superannuation to always be tax-free from a withdrawal point of view post age 60? Well, we just don't know. We don't know what the future holds from a Treasury and government policy point of view. Take a very brave government to change the tax status of super benefits post age 60, but we've seen so much change over the last 20 years in that regard that nothing would surprise me in that space. So having an appreciation for all of the various strategies is important. So the first one that I want to focus on is one that I tend to update and keep as fresh as possible, which is the use of the carry forward unused concessional contributions. And I think this is such a such a fantastic strategy from an opportunity point of view for a very significant number of SMSF members, right? So if we say there's a million, I'm just obviously just keeping it on a rounded number there. If we say there's a million self-managed super fund members, and we say that 50% of those are accumulating, still, and it's possibly more than that, then we know that the median balance is below $500,000. So that point, so we take out the average because we take out those funds with 100 million and all those sorts of numbers, and we say, right, who's sitting smack bang in the middle of the superannuation scope, and basically more than half of the SMSF population have less than $500,000. So that gives us I guess, the understanding that a lot more people are eligible for this carry forward amount than not, potentially, because factor in obviously pension versus accumulation and other things. But a significant portion of superannuation members in the SMSF space have that entitlement to carry forward. Of course, it's available outside a self-managed super fund, but the add-on strategies that I'm going to build into today's presentation are not necessarily available outside the scope of super. So when we look at the carry forward and what it can do, we're identifying our clients with less than $500,000. And this is a year-by-year strategy. So this is something that we're looking at each year. What was the balance at the preceding year, right, to determine what their deductibility is or what their contribution cap is in the current year. And so we understand from what I mentioned before about indexation that the concessional contribution cap is $32,500 next year. currently $30,000. So that is the standard cap. And then we each, subject to our total super balance, might have more if we have contributed less than the cap and we have less than 500,000. And so even when there are spikes, so even if we have a year where the balance goes up over and above 500,000, if it then subsequently dips below, then we can still go back that full 5-year period. Similarly, from a strategy point of view, you don't have to have been in superannuation for 5 years. So if you've got children who come into significant earnings once they become an adult, so they turn 18 and they've got significant earnings and they've got the capacity to make contributions in addition or in excess of the single year cap, then they can go back 5 years. And of course, if they've contributed nothing over that 5 years, then they've got a higher amount. The same with the foreign travelers. So people that come into Australia, not foreign travelers, foreign residents who migrate here and bring their money into super and work here, they might have more than that 1 year's cap available to them. So there's lots of reasons why we might use the unused concessional carry forward amount. And if we can, we know that we can go back and utilize up to 5 years worth. So we're looking far as back as the 2020-21 financial year. So, I've refreshed my numbers here with regards to clients and strategic opportunities. We've got someone here, Heather, who's on $100,000 per annum. I've kept it pretty simple there and just receives the employer super guarantee. And we'll use Heather as the example throughout a reasonable portion of the strategies that we discussed today. So we've got some consistency there. So the $100,000 is the income and receiving the super guarantee amounts on that. So as we track along, we know that by receiving just super guarantee, that there is an entitlement or there is a gap between the super guarantee amount and the concessional cap. And so that amount carries forward. We notice it's 1 year where Heather's total super balance was above 500,000. So that year she would have only been entitled to the single year cap and have that appreciation for how that works. But if we look at it, we go, okay, well, what is Heather's cap this year? Well, the concessional cap is 30,000. Her unused cap is 85. Receives employer contributions, and it's obviously really important. And this strategy to me becomes a lot cleaner in a payday super environment, right? So once we move into the new payday super, when we know what contributions are going in and the expectation that they go in the year of that they are earned, right, will certainly make the process a lot simpler. Yes, arguably for the final contribution of the year, if somebody is paid, very late in June, and that contribution goes in, say, 7 days later, or whatever the number is, then there's scope for it to move into the next year. But by and large, the contributions for the year are going to be known because they're going to be linked to pay. So, within a reasonable scope, people are going to be able to do their calculations a lot better from the 1st of July next year. So this gives Heather the capacity under the cap, the carry forward amount minus the SG gives her and a capacity to do $103,000 worth of personal deductible contributions. Now, Heather might not need to or might not want to utilize all of that, but that's a fairly significant amount of scope for her to offset the entirety of her tax on income. So, arguably, you've got the tax on the sale of the property. So if she gets a 50% discount on that, on whatever the property is valued or whatever the gain is at that point in time, she might work it out. But she's got up to 103,000 that she can claim from a deduction point of view. So that's the strategy in its simplest form. But as you know, we can then move it forward a step and we can say, well, what about the use of contribution reserving? Now, this might not be something that's valuable in Heather's situation. She might not need it, but we get to the situation where clients are effectively in their final years of high income earning, and they're going to have, maybe they're moving into pension phase, and so they're going to have non-assessable income afterwards, but they've got significant tax offence in 1 year. So they might want to effectively bring forward, and I'm almost loath to use that given that is actually a legislative term for non-concessional, but they might want to bring forward next year's concessional contribution cap to make a significant contribution in the current year. And so we're actually effectively carrying forward anything unused and bringing forward something that we're not going to use in the future from a contribution point of view. We know that this is a legitimate strategy. We understand that that there is a process to go through. We also know administratively it's clunky because it doesn't look like you're doing the strategy because you're still reporting the contributions as being received by the member. You're still reporting it as an assessable contribution in the fund's return. You are just making the application to the tax office to move that amount forward or to utilize the next year's cap. Um, rather than the current year's cap. So you've got to use the appropriate request to adjust the concessional contribution form. But from a pure admin point of view, you don't actually create contribution reserves in this situation. And so what it looks like, and if we look at Heather's situation there, we've got the 2025-26 concessional contribution cap. So we know that is the $85,000 or whatever, would make the $32,500 in June. Right now, if it just went in June on its own, that's going to create an excess situation for her. But what we do instead is we pay it in June and we allocate it. So by virtue of utilising the ATO process and minuting it, we've got to make sure that one, it's provided for in a deed, and two, that it's minuted as the contribution is being held in a reserve, to be allocated within 28 days following the end of the month in which the contribution is received, held in that reserve, pushed out and then reallocated to the member in July of the following year, so July 2026. Now, one of the important things here is that this strategy is not impacted by payday super, okay? So the personal deductible contribution that you're making, you've still got that 28-day allocation piece for this to occur. So there's no impact on this strategy by the introduction of payday super. So it ultimately produces a good outcome from a non-concessional, from a concessional strategy point of view. It doesn't create an excess contribution, but it gives you significant deduction power in a year where you've got unusual events. And in this case, it's the sale of the property that might create that event for Heather to do. So as I said, it's not always suitable for SG employees, but we know because Heather has her 12% that she's being paid on her $100,000 that it works for her situation. So when we then look at utilizing the unused concessional amount plus contribution reserves, right? It changes the nature of the transaction to enhance what we could actually do. So not only do we have our concessional cap of 30,000, we also have our unused amount of 85. We take off the current year's 12. Now we don't jump in and go, right, well, we've then got another 32 and a half because the concessional cap is going up next year, right? We have to be smart if there is super guarantee involved and say, well, actually, in Heather's situation, she can really only, on the assumption that she can earn $100,000 in the following year, she can really only contribute 20,500, being the balance between the 12,000 SG that she's going to receive and the cap for next year. So she actually increases her deductible amount to 123,500, and that can provide a benefit for her from a taxing point of view. And so strategically, we see once we start to build one on another, it can provide further opportunities for our clients in not only an accumulation point of view, but also a tax point of view, because this strategy is not only assisting Heather get the money into super, but it's also helping her reduce her personal tax liability on the outside, which is one of the reasons we make contributions. And then we can look at it from one additional and final step, and that is this concept of spouse contribution splitting. And again, we look at it and we go, okay, well, is Heather in a blended family? Does she want a contribution split? But contribution splitting, particularly in light of Division 296, I appreciate that if we're talking about 30,000, 32,000, whatever the concessional cap might be, that size money on its own is not going to make a difference in member balances with more than $3 million, right? But if we can, the earlier we can look to equalize balances, spouse balances, then the more we can either remove or potentially remove that Div 296 liability, or at least reduce it by putting some money over from one interest to the other member's interest. So we know and have an appreciation for how contribution splitting works, right? We know that the spouse, the receiving spouse, right, they have to be basically employed, right? So they have to be under 65 to start with. And if they're between 60 and 65, so if they're between preservation age and 65, then they can't have made a declaration of retirement. So they can't cease gainful employment and have access to their unpreserved money. So it was an integrity measure when contribution splitting came in, probably back about 2006 from memory. But it was an integrity measure to say, well, we don't want older spouses splitting their contributions over to slightly younger ones to be able to access the money, or more to the point, you don't want younger spouses allocating money to older spouses for them to be able to access their superannuation straight away. So there were these integrity measures that were built in, and of course, it's only applicable to to concessional. Let me say that again. It's only applicable to concessional contributions with the way that it works. However, the strength of contribution splitting is that it's based on this maximum concept, right, being the lesser of 85% of the concessional contributions to that financial year and the concessional contribution cap for that financial year. Now, importantly, that's not the standard cap. That is the individual's concessional cap for that year. So there is actually a link between contribution splitting and the carry forward unused concessional contribution amount. So where we've got someone with less than $500,000, the amount that they are entitled to split to their spouse will actually be enhanced by the fact that they've got unused contributions historically, and that's where we can add some value and potentially conceptually add additional strategic opportunities to their client. And again, if we look at Heather, as I said, wanting to use her as the example here, her balance at previous 30 June was 495,000. Okay, so less than super, sorry, less than 500,000, right? We know that she had the unused concessional amount of 85, so she had great scope to make contributions. If Heather utilized that full 123,500, right? So that's the unused cap plus the reserve amount, then all those contributions are allocated to her in that year. So 123,500. So regardless of what adjustments or anything else we do, that's the amount that's going to her. She's also got the 12,000 from her employer. So her total concessional amount is 135,500. If we then go, okay, well, Heather wants to split her contributions with her husband, John, right? And John's self-employed, running his own business, doesn't have a lot of money in super. Okay, so Heather's accumulated more because she's been receiving consistent employer contributions through her working life, whereas John has put more money into his business. So he might avail himself later to the small business concessions and make contributions. But at this point in time, he's not been putting that money back into super. But we can split, and we can split from Heather to John. Now, the timing of the contribution splitting is going to be subject to what Heather does. So if Heather's going to commence a pension, so Heather's 60, right? If Heather's going to start a transition to retirement income stream or something, then the split would have to happen before that point in time. So if you look at it from a process point and you look at the various contribution strategies that we've talked about so far, she would make her personal deductible. She would have to make a notice of intention to claim a deduction first, and then she would need to do the contribution splitting next, and then she would do a tryst commencement if that's a path that she was to go down. So yeah, there's a lot of steps that we have to get in the right order to ensure that everything is valid from a pure tax administration point of view. So most of the time, the split will happen in the financial year following the year of the contribution. So we see how much has been put in there, and we'll do that split during the 26-27 year. But Heather can split up to $115,000. And it's like, okay, well, the 115 is obviously a lot higher than the cap, but as in a lot higher than the standard cap, but it's the lesser of 85% of the 135,500, which is the total concessional, because that's 115,175, and her concessional cap of 115. So the lesser of those amounts means that we can split $115,000 from Heather to John, right? Now that does a few things, right? As I said, from a timing point of view, Heather's got to do her notice of intention to claim the deduction, so the 123,500 there. She's got to put in her request to adjust her concessional contributions for the 20,500. That's not a super fund process. That's the personal process, and that can happen generally. It's going to happen around the time of lodging the return. There's no specific time to do that, but it's more that you should be doing it as soon as practicable, so the ATO can match that data up. And then you do the super contribution splitting application for the 115,000. Now, in doing this and following down this path, we've done one of two things, right? We've got the large tax deductions for Heather to offset her tax return in those years, but we've also enhanced Jack's balance, and we've basically doubled Jack's balance in a single transaction. But in doing that, we've also ensured that Heather's balance is pretty close to that $500,000 mark. So it still puts her in scope of unused concessional contributions moving forward. Now, appreciating that she's, in this example, has maximized everything that she can use, but if she's maximized everything she can use and she's used a bit of next year, well, in 2 years' time, in 3 years' time, in 4 years' time, as she's approaching 65, she might still be able to, if she's just getting the super guarantee amounts, she still might be able to carry forward unused amounts, as she's approaching age 67. So there's scope for multiple users of this strategy. So to me, it's a good thought-provoking strategy, and not just unused concessional on its own, not just contribution splitting on its own, and not just the use of reserves on its own. All three of them are valuable strategies in the singular, right? So all three provide great opportunities for clients, but it's that combination opportunity as well that we can provide, that we can potentially get the best outcome for our clients. And this is where I move into TRIS and contribution strategy. So whilst this is not a pension webinar, what I wanted to highlight is that TRIS, it's been through a few iterations, and of course the biggest one being that from 2017, we know that we have this concept of TRIS, ultimately from a fund point of view, being considered similar to an accumulation interest, in that the earnings are not entitled to the exempt current pension income deduction, right? So it means we can start a TRIS from age 60, right? So we can transition to retirement, we can satisfy the condition of release of attaining preservation age, and we can draw down our income, right? So what does that do? Well, it gives us the capacity to recalibrate money between spouses, and I'll have a look at that shortly as well. But it also gives us the ability, from a tax point of view, to get ourselves into a better tax position through the use of such strategies as salary sacrifice. And so, TRIS has multiple benefits linked to it, subject to what you're trying to achieve with your clients. The other beauty of it is that a TRIS is not reported against the individual's transfer balance account until they meet that condition of release, retirement, or turning 65, permanent disability, one of those ones. So we have this scope to look at our larger member balances. And this is where I think what's really important in the next 12 to 15 months in the pre-assessment period of Division 296, that we're looking at our clients that are at preservation age but are not retired, with large balances, where potentially you've got one spouse with a large balance and one spouse with a lower balance, to look whether or not a TRIS might be beneficial. But we'll come back to that piece in a moment, because what I wanted to look at first is TRIS and salary sacrifice, because what we know is we came in from, I think it was 1 July 2024, but the rates, that should say post 1 July 2026 up there in that top bracket there on the right hand side. But we know that the lower tax rate, well, firstly, the threshold was raised to $45,000. It was initially dropped from 19 down to 16, and from next year it's going to be moving to 15%, and then from the 1st of July 2027, when we get the changes to the listo, it's going to drop down to 14%. So it ultimately makes the conversation piece around money inside or outside super an interesting one from a client point of view. But in using it with things such as the carry forward concessional, it can also provide our clients with some significant opportunities. And so again, if we look at Heather's situation, and we're just looking at purely as a numbers point of view, and so we're not contemplating this in light of the other strategies with Heather. This is a separate scenario, but it's a potential opportunity for us to go, well, what opportunities do exist for Heather? We know that she's got significant cap space, right? We also know that she's 60, and we also know that she's got roughly $500,000 in super. So what does that mean when we're looking at her $100,000 income versus her $500,000 super balance, and the fact that she hasn't used her carry forward contribution? So assuming she doesn't make her personal deductible contribution of that 103, we've got that opening balance of 495. Right, we've got employment income, and we're going to look at this without salary sacrifice and then with salary sacrifice. So $100,000, and these numbers just assume pure tax rates, no Medicare levy, no other rebates and offsets and other things like this. Pure, look at your tax tables. Here's your amount of tax that you're paying, right? $100,000 income, $20,000. So basically $21,000 in tax. So Heather goes home with $79,000, right? Her concessional contribution cap, 115. We know that because of the amounts that she's carried forward over the time. Super guarantee is 12,000. No salary sacrifice, $1,800 tax on the super amount, combined tax of $22,500, right? Takes home 79,000, has basically 500, 5 and 5,000 in super. Let's now look at that with a tris and the fact that she's eligible for the carry forward concessional amount, right? 495. She drops that down. She salary sacrifices, comes to an arrangement with her employer to contribute to drop off 55,000. So reduces her income down to 45,000. Why is she doing that? That takes her back down to the 15/16% tax bracket, right? Personal tax, $4,288 under the current regime. So take home pay, 40,712. Her concessional cap, 115,000. That hasn't changed. Super guarantee, 12,000. We know that she's got 100 odd, or she's got 85,000 this year available in carry forward concessional contributions. So we sacrifice that $55,000. Right? That $55,000 plus the 12 results in tax in the super fund on those contributions of roughly $10,000. So her combined tax has gone from 22,500 down to under 14,500. So she's got a saving there of just over $8,000. We then go, okay, we can trigger a tris, right? We can commence a tris for Heather. We know that it's non-assessable, non-exempt income because she is 60 years of age, right? We know that we can pay up to 10%. So we can actually pay up to $49,500 here from based on her balance. But if we draw 38.5, that 38.5 triggers us back or takes us back to the 79 that we were drawing previously. What it does, though, it gives us a scope to go up to 90,000, right? So we can actually increase our income, pay no further tax, so we can draw up to $11,000 more. But if we don't, and we just draw out that 38,500, then our super balance goes from 500 to 513. So by doing the salary sacrifice and switching it up with a tris, we're not only taking home the same money, we're paying less tax to do so, and we're ultimately increasing our super balance at the end of the year, right? So of course we can, if we take the maximum, if we go to 49.5, then we're going to decrease our balance. But we're only decreasing it by a couple of $1,000s, $3,000. So, the enhancements that we can make by doing the tris and salary sacrifice is significant. So any client that's earning above that, ultimately 45,000 people are going to look at their income anyhow. But any client that's earning over and above that first tax bracket and can sacrifice down because they've got unused concessional contributions because they got less than 500,000. And again, from a pure income point of view, from a pure numbers point of view, it's certainly clear in my mind that when we're looking and targeting specific clients, clients that are earning in that less than 100,000 are going to have a bit more likely to be those clients that have less than 500,000 in super, right? And so therefore, they fit perfectly into this opportunity from a strategy point of view. So that's just a typical strategy that we should be looking at for a lot of our clients. The other one is TRIS and the spouse contribution piece, right? And I think this now is where we cross over into our area of the Division 296 as well. And so if we look at the situation here, we've got Jeff and Jill. Jeff's got 2.5 million in super, right? 30 June 2025. So Jeff's still working, right? And but he's no longer eligible to make non-concessional contributions at this point in time. Can make downsizer if he wants to, but hasn't sold the house. Jill's got a lot less money in super, right? Could have been a stay-at-home mum for a long period of time or whatever it might have been, but she has a lot less money in super. And this is not uncommon. We see this sort of balance disparity in self-managed funds all of the time. Jeff's going to keep working up until he's 65, and Jill will be 68 at that point. Of course, at that point, they'll still be able to make non-concessional contributions. But if we look at it, right, the negatives is that Jeff has limited or no ability to make non-concessional contributions. He's working full time, so his benefits are preserved until he retires or returns 65. Jill's total super balance gives her effectively unfettered ability to make non-concessionals up to the caps, can continue through to 75. So she's got another 10 years of it there. And the fact is Jeff's at preservation age. So he's gone beyond preservation age. So he's got a capacity to start a TRIS. And that TRIS is going to be non-assessable, non-exempt income. Now, the key here, of course, is that with Jeff, not only is it non-assessable, non-exempt income, but it's not measured against his transfer balance cap because it doesn't count while you're still sitting in accumulation. So the fact is he can start his pension for 2.5 million. So this is the beauty of our 60 to 65-year-olds, particularly those with, near enough to or over $3 million, right? They've got the capacity to draw a significant amount out and potentially rebalance with their spouse, right? Either this year and a combination. So you might get yourself caught up with Div 296 for a year or so, but then you can actually incorporate strategies to move money from one to the other pre-death and appreciate that estate planning is a whole separate issue when it comes to a lot of these situations with Division 296 that people have to take into consideration. But what we can do is we can start the TRIS, draw down our 250,000. We can contribute that 250 into to Jill, triggering our bring forward. Now, I also appreciate that it's probably not the smartest thing to trigger the bring forward this year, but again, this is just for highlighting the opportunities. So whether they deferred this transaction or whether or not they deferred it so that he drew down at 30 June and then he made the contribution into the new year, there's plenty of opportunities there for Jeff and Jill, right? So then his balance drops. So his balance goes down. Again, I haven't appreciated any growth or anything here. Drops down to 2.25. Got 225,000 pension, still non-assessable. Right? We can make up a balance up to the 360 for Jill next year. So she's into the second year of the bring forward amount, which would mean basically for 27, 28, Jill is locked in, doesn't have any contribution concept. We have to appreciate that situation. Her total super balance, though, the next year is basically just shy of 800. Again, no capacity to contribute. Jeff's total super balance at 30 June 27 is now 2,025,000, right? He's got his minimum pension of 202,000. Again, non-assessable, non-exempt income. We know come 2028, Jill can now contribute up to 390,000. All right. So that's going to be a significant push up for her. Again, being well below the general transfer balance cap means that there's nothing holding back that capacity for Jill to make that contribution. But we also know that Jeff can potentially look at his own balance there because he's now under the general transfer balance cap, right? So his balance under general transfer balance cap. So he could potentially start to look at using these strategies for his own benefit. And if Jeff, for example, let's forget Jill for a moment there. If Jeff pulled out
and he's interested at this point. So if he pulled out that 200,000 there, then the next year he could put that back in and start another pension, but 100% tax-free pension, right? So we're now starting to look at the estate planning proceeds of what opportunities are existing for the clients in that scenario. So we're creating these opportunities by looking at these strategies. But what we've done is we've, in this case, brought Jeff from over 2.5 million or around at 2.5 down to under or about 2 million. So we've pushed him from an accumulation interest which is already paying tax, even as a tris, right, to $2 million. In the next year, he can start his account-based pension because he turns 65, right? So he hasn't retired, he can turn 65 and he can trigger an account-based pension. That means that full balance of Jeff's is going to be in exempt pension income. We've now got 1 million over there sitting under the name of Jill. Of course, Jill could have at any point in time, because of her age, she could have triggered the pensions to be in account-based pensions and therefore be entitled to ECPI. So we actually create a double benefit for this fund. Not only are we reducing Jeff away from Div 296, but we're enhancing the fund's tax position by putting them both in an exclusively ECPI environment from an account-based pension. So it's hugely significant what we can do, and we've got time to do it. And I think that's one of the sort of the second to last piece that I'm going to show you from a strategy piece is the whole personal contribution and recontribution piece. So I just indicated before when I was talking about concessional contributions that the median balance was under $500,000, right? Well, what that means is that a far greater number of people have less than, say, 1.7 or less than even 2 million, if we want to use that as a number. And as they hit 65, right, and they hit the ultimate condition of release. So we know we appreciate 65 as being the ultimate condition, right, where we can access our money. It gives clients, and again, liquid-based clients. So we've got to contemplate the investment strategies of the fund, but it gives us this capacity to take, in this instance, by purely utilizing the 3-year bring forward rule, and by purely utilizing the expected caps at the time. So I've factored in, an expected growth in the non-concessional cap over each preceding 3-year period. But we can take a client with that $1.7 million and we can draw down. So we start our pension, right? But we can draw down 390, recontribute it, right? Because we're under the cap, we're under the 3-year bring forward cap opportunity, right? We can then do it again with 420. We can then do it again with 450, and then can do it again at 480, and that's at year 75. So the year we're turning 75, we've got 480, and we know that the benefit is with the bring forward, we're actually almost getting two, and I shouldn't say two cheat years, but we're getting 2 years where we otherwise wouldn't be able to make that non-concessional contribution. So this then becomes a significant estate planning strategy. It gives us that opportunity to go, right, we've got taxable components, right? Because a big part of Div 296 is not the Div 296 liability, right? It's the add-on of keeping money in super, the surviving spouse being hit with Div 296, the beneficiaries being hit with PAYG, right? So there's the flow-on effect of not only liquidating assets to pay out benefits, people being over their general transfer balance cap, so CGT there, Div 296, CGT, and PAYG on the death of a member. So if we can plan ahead and look at the recontribution strategy, then it's still a no-brainer in regards to those clients in that 10-year period where they've got full access to their superannuation benefits. The last one that I wanted to touch on before sort of talking a little bit about the exempt pension income, not sorry, the exempt pension, the excess contribution piece is the downsizer one. And so, Heather sells the investment property, right? And she lived in it for over 10 years. Or so she's owned it for over 10 years, lived in it before her and John got married or purchased a house or whatever. So she's had this property for a while. So it qualifies under the partial CGT exemption requirement. So Heather's got the ability to use a downsizer contribution. There's no issue with her doing that. Heather's also 60, right? And so, does Heather want to do that? or does Heather want to just make a non-concessional contribution? Because if her and John own the place together, then, they could sell that and potentially use the proceeds from that to top up their super at a later point in time. So, the fact that we can qualify for downsizer from 55 doesn't necessarily mean we should use downsizer for 55 because we've still got access to non-concessional at that point. Certainly from 75, where we lose the ability to make non-concessional, that's when we would potentially start to focus in on downsizer. But what we've got to be careful of is that with this fund cap contribution rule removal that I mentioned earlier, what this puts us in a position of is if you get downsizer wrong, similarly, if you get CGT cap amounts wrong, up until 75, they're going to be treated as non-concessional. So if you've got more than the $2 million in super, if you've maximized your caps, if you've done lots of other planning around utilizing the bring forward, and you inadvertently make a downsize that you don't qualify for whatever reason, or you make a CGT cap amount, then those amounts will count towards non-concessional and they can't be refunded. So we just have to make sure that we're comfortable in understanding the ramifications of getting it wrong, which means we need to know what happens when we do get it wrong. Okay, so what we know is we've got our caps, we've got our current caps, non-concessional 120 up to 360 at the moment. We've got our concessional of 30,000. If we exceed the caps, there are consequences, and those consequences are that we fit under the excess concessional contribution regime. Now, ultimately, it doesn't matter how you exceed the caps, or it doesn't matter why you exceed the caps. There are very few reasons for the commissioner to, other than the strategy that I highlighted before with the reserving strategy, there's very few circumstances where the commissioner will go, that was a genuine mistake. You can return that money, right? Or you can allocate it to another year. In the scope of non-concessional contributions, generally the commissioner's position is tough luck, right? Now that's tough love, but it is tough luck in their environment. And so what it ultimately means is that clients are going to be subject to the excess contribution regime. Exceeding the concessional cap, you end up being taxed at marginal rates. There's a release authority provided. You can release that super and you get the 15% tax offset. The beauty of doing that is that the amount won't count towards the non-concessional cap. Right? But if you leave that money in super, so you go, well, I've got the money outside to pay the tax liability, you leave it in super, then that amount will count towards your higher non-concessional. Of course, if you've put in 120 non-concessional, well, then that excess concessional is going to trigger the bring forward. And if that triggers the bring forward, but you're already in the next year and you've already utilized your bring forward, then you're going to then exceed the non-concessional amount. Of course, if you exceed the non-concessional amount, you've got two options. But I think most of us, if not all of us, will say you've really only got one option, and that is refund the excess and 85% of the associated earnings that the tax office will calculate. Well, now, when I say refund the excess, refund it through the ATO mechanism, right? So don't take the money out, wait until you get the assessment, and then choose the option to refund it via the ATO process. Because the alternative is you pay the old excess non-concessional tax of 47%, which is clearly not an ideal outcome for anyone that exceeds their non-concessional contribution. So people really need to be careful if they've making personal deductible contributions, if they're doing the CGT cap contributions, personal injury, anything that they think they qualify for that they actually don't qualify for, utilizing the carry forward, utilizing the bring forward, but also things like gnarly rectifications. Okay, so ensuring that we're dealing with things on a non-arm's length expenditure point, so we're not treating amounts as contributions and getting captured under the cap. Same with foreign transfers, ensuring that we understand that the numbers and how they will count as non-concessional and how all of it will count as non-concessional in the first 6 months, for example. So number of different things to take into consideration. So lots of opportunities still available to us up to age 75 and a few beyond there. We need to know how they interact and whether there's value in them interacting for our clients. We also need to know the appropriateness of them in links or in relation to things like Div 296, but also estate planning. So lots to still contemplate in that contribution space. And a lot of the problems are associated us with us doing the wrong thing. So failure to make elections on time, failure to lodge it, failure to get the contributions in on time. So we need to make sure that we're on top of it and appreciate that that's all based on what the law currently says, and we know that the legislation can change at any time. So look, that brings us to the end. Right on. It's smack on the end time for us. 19th of May, next webinar. I'm about to sit down with SuperGuardian to discuss this. Doing a countdown to Div 296, right? So, well, I know I did a February webinar just as the legislation had been released. Of course, the law's now been passed, and we've got regulations, which are still in draft format. But my hope is that by the 19th of May, we have the final regs, so we can run through exactly what you're looking at for your clients with regards to Div 296, and then we'll utilize that, and we'll have a bit of a think tank about what we do from a June webinar. But most likely, we'll look at the planning for the end of year lodgement stuff and the year ahead from a strategic point of view. So thanks for joining. As I said, SuperGuardian will issue your CPD and the copy of the slides. So they should come out to you in the coming days. So thanks again. I look forward to you all joining me for the May webinar. Bye for now.